Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Every once in a while, I hear a new saying to me, and today's guest, Roman Kirzhner, zooming in from New York, just said it off camera. He said that multifamily real estate investing is a contact sport, and a big part of that is making contacts. So I love that. So Roman, welcome to the show. Great to have you.
Nice to have me. Thank you very much for having me. Absolutely.
Yeah. So Roman, you focus on a particular size of properties when it comes to multifamily real estate investing. Tell us a little bit about that, why you've picked that niche, and what the portfolio looks like right now.
Sure, absolutely. As many of the investors in real estate, I started as single families investors, and it was a hard step up to scale my business after 15 years of doing this and managing about 50 different doors by myself.
Yeah.
So it was a time to scale up to multifamily, and I found that niche that not everyone is looking at. It's a small to mid-size amount of small multifamily real estate investment, meaning between 20 to, let's say, 60, 75 units.
Uh-huh.
And that's my sweet spot. I feel comfortable doing that. It's and I became proficient in this.
Yeah.
I can say that.
So as the time of right now, where it's in May of 2026, and we're recording this, what does your portfolio currently consist of when it comes to multifamily properties?
Sure. We've been doing multifamily for the last 8 years, and in any given times, and it's not a magic number, but it's just what happens to be. We keep in about between 100 to 130 units at any given times, and we try to create conveyor belts, so recycling whatever we keep in for 3-5 years. Sometimes it's 2 years, sometimes it's a little bit longer. But if the time is right and it's not a marriage, you can divorce it.
Okay. All right. So it brings a couple of questions. Number one, the size of the property. You said that that's your sweet spot. Why? Why not smaller? Why not bigger? Why is this like the Goldilocks for Roman to this size?
Great. It's another component of it. It's a liability. And liability is the size of the loan that you can get and the money that you can raise doing this. The size of the property should consider to be financed by non-recourse mortgage, where you have no personal liability, just by LLC that's created by. And another portion on another side is the ability of you to raise capital, comfortable raise capital, because sometimes, and not sometimes, most of the times, raising capital is 24/7. That's what I do 24/7.
Yeah.
But you have to be reliable partners to everyone, so you can be qualified for the loan. You have to have some history of an experience of real estate in multifamily, and that's the reason why it shouldn't be, let's say, the price wise, it shouldn't be less than $1.5 million. And it shouldn't be more than, let's say, $5 million. That's my buybacks is all about.
Okay. All right. So a combination of liability and ability to get the right kind of financing and to raise the capital for it.
Yeah.
That's the main reasons there. Now, the other question I have is your exit strategy. So you mentioned that you're not married to any of these properties long term. You're happy to divorce them when the time is right. So what does that look like for you? Like what's kind of the big picture strategy that you explain to an investor as to why you're selling these properties after 2, 3, 4 years?
Sure. In any given times, my priority and our business structure is investors, LP, limited partners, comes first. And we offer them preferred rate of return. And that's my major thing in this business. I proudly can say that we never lost investors' money. Sometimes I'm putting my own money and my partner's money, who is on the GP side, which is not unusual, but Sometimes it's hard to do.
Yeah.
We offer in certain, depends on the time of the year, let's say, and economic conditions, we can offer preferred rate of return. We're looking also on so-called ARR, annualized rate of return. If the property in my structure, if the property can guarantee at the sale or refinance between 16 to, let's say, 18% annualized rate of return, it's time to sell it. That's the criteria that we have.
I got it. Okay. All right. So it's all about timing it to get your investors the return that you told them they're going to be getting at the right time.
On the top of providing them cash on cash return on quarterly basis.
Yeah. Okay. All right, that's making sense. So we're clear on the size of the properties that you're looking at and why you're looking at those. Are these typically like just plug and play properties that are already in pretty good shape? Are they value add properties? What are you typically doing to get that rate of return for you and your investors?
Absolutely. And we divide that into two categories. One of them is a stabilized property, meaning that if the property is, let's say, around 90% physical vacancy, that's called stabilized. That's the base to get the proper financing, and we can offer our investors cash on cash, preferred cash on day one. If it's value add proper opportunity, which means that occupancy or vacancy more than 20%, that's actually is a great thing. But in this case, either we will negotiate the price, so we will be able to pay our investors at least something in day one, or we can talk to investors and they have to understand that it is a business that they have to wait until we execute value add portion of it, and we can hold that distribution for 1 or 2 up to 3 quarters. And if everyone understand that upfront, we have no problems with communicating with our investors.
What are you typically doing for your value adds, Roman?
It's not really dramatic renovation, but light rehab to bring it to the market standards in that particular market, that we can increase the probably rent averaging on probably between $50 to $150 per unit, based on market price.
Right. Okay.
And we know a little bit about what it should look like. We don't want to spend $20,000 per unit on the repair works, and we don't want to put granite countertop when there's no need for that. It's called return on repairs. That's another.
Not a vanity type thing, right? Return on repairs. I like that as well. Okay, very cool. Very, very good, Roman. So I was going to ask you, if I'm not mistaken, you're based, I think, in New York. Is that correct?
That's correct.
But your properties aren't. So what do you do as far as like long distance management? Is that challenging for these smaller properties, or what do you do for property management?
For people who might start with this business, it might be challenging. That's one of the reasons why I have no problems with that, because I was managing properties by myself, driving between New York and Philadelphia for 15 years, doing property management for single family and up to 4 family houses. So I know how to change the toilets and how to deal with rent collections.
Yeah.
And that's the reason why I feel comfortable managing other managers. So we hire in management companies, and we have in constant communication with management companies. If the property doesn't perform well, we have a weekly meeting. Actually, we do have weekly meetings with all of our management companies. And what I'm saying to my managers, obviously, for some reason, I am the guru in this. I'm saying that if the business works fine, it's a really boring business. Let's get to the point when it's becoming boring. So it means I don't want to see you, and you don't want to see me.
Yeah, these weekly meetings get boring, but that's good. That's a good thing.
That's the whole idea, to make this business boring.
Yeah.
That's what I do. And finding a proper management, it's a skill as well. you have to go through a couple management company. You have to look at the management contracts. You have to analyze them. You have to have referral, of course. And that's a part of the job that we're doing.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
Yeah. Okay. Now you also mentioned another big part of your responsibilities is raising capital. You said you're kind of doing that 24/7. You've been doing this for a number of years, Roman. Were you raising capital back in the single family home days or just self-financing?
With the single families, I was able to get capital from my friends who were like teaming up with me. And that's where it was a relatively simple capital.
Like more like joint venture deals.
Joint venture, right? Where you can buy. Back then in Philadelphia, you could buy property for $30,000, $40,000, $50,000. We were buying it for cash.
Yeah.
Renovating it for $3,000, $5,000, putting people in for $800, basically refinancing, taking capital out, moving to the next one.
Yeah.
Back then, I learned that individual can have only 8 mortgages on his name, which is kind of interesting.
Yeah.
But that's a different story, right?
Yeah. So now that you've gotten into multifamily, how has your capital raising changed or modified?
First of all, you cannot do it by yourself. That's number one. You have to realize that that's not the business to be alone.
It's a contact sport, like you said, right?
Yeah. And you can do so much, but after all, you either stop doing it. If you want to scale up, you have to be involved in capital raising and people's relationship. That's relationship sports as well.
Yeah.
And we start with a small group of friends and families that knew me, and we grew up. Right now, I have team. It's 4 people in different states. Each one of them has a different role. One of them in Texas, another 2 in Pennsylvania. I'm in New York. And each one of them has goals to go and talk to the brokers, talk to the people, and have at least five calls per week. So after 1 week, we have 20 calls altogether, and you have 20 connection, I would say, between brokers and investors. And once you have certain amount of people, like enough people to talk, you can invite them on a Zoom call, and you can start talking. Because after all, it's not about the property. What I learned about this business is not about bricks and mortars. It's about trust.
Yeah.
People put in money not in the buildings. They put in money in me. And I'm asking myself, who am I for you to give me $50,000?
Right.
So basically, that's what it is, and that's what our we're happy to share our knowledge. We're happy to share our approach. We're happy to share what our pros and cons, our success and failure. And if anyone will tell you that I don't have any failure, they will be lying. And we all have failure. They all lost money.
So what I'm hearing with the capital raising, which is really smart, Roman, is that you're a team of 4, and each one of you is responsible for connecting with at least 5 people a month, right? Is that
a week.
5 people a week. All right. So that's about 20 new connections a month. No, sorry, that's 5. That's 80 new connections a month.
Right.
And then do you do like a monthly, you mentioned Zoom, so do you a monthly webinar or something like that you invite all of those new connections onto?
That's what we're trying to do.
Yeah.
On the Zoom calls. Not always happening, because not always you have interested party who might be willing to spend another 30, 40, 50 minutes of talking to you.
Right.
But yes, that's the goal that we try to keep in place.
That's really smart. Yeah, that's a really smart methodology. So when you're talking on Zoom, are you presenting an opportunity? Are you going over an existing deal? What do those Zoom calls typically look like?
Typically, it starts with presenting ourselves. It starts with showing our track records, what we can do. It's showing that we know what we all about, and we good guardians for your money. That's what we have to pass idea to the people who are
Right.
participating in that Zoom calls that we are people who will be treating your money like our own. And after that, we can talk about, in general, discussion about markets, about properties, about what size of the property, like we have a discussion right now, what we're doing, how we're doing, what the strategy and what we can offer. And we're trying to be within FCC law. You cannot basically start talking about your property day one with people
Yeah.
who you not establish any relationship, except it's accredited investors anyway.
Right. Right. Okay. Very, very cool.
Yeah.
And then when you do have an actual deal on the go, is it basically the same thing? You invite everybody on your list to a webinar and show what it
Absolutely.
is? Yeah.
Absolutely. Yeah. Right now, we're talking about property in Texas, 60 units. I'm still negotiating the terms and prices and everything else. But we already start spreading the word that that's what we're working on, the 60 units in Texas, in that market that we already have a presence. We will be having the same management company because it's the same city. So, and that's creates kind of trust level that we want to start with.
Very good. Yeah. No, that's really smart. Okay. And Roman, you've kind of explained your process. So you guys aren't looking to, some folks have very, it almost sounds like vanity goals as they want to have 3,000 units under management or $190 million of assets under management or all these different things. Sounds like you've got things dialed in. You're looking at consistently having 100 to 130 units in the portfolio, turning them over on a regular basis, cashing investors out, getting them into the next deal, consistently filling the funnel with new faces, which is really smart because a lot of people just kind of rest on their laurels and figure, hey, I got lots of people already. I don't need any new ones. But yeah, you do. You always need new faces, new people to be talking with. So it sounds like you've got things pretty dialed in. Are you planning any expansion or changes over the future, or you just kind of want to keep it chugging like that?
All right, that's a great question. Actually, it's not the first question I answer. Yeah, we're always looking for scale up, and you just mentioned people who wants to have 1,000 units, 5,000 units, 300 millions under management. It means nothing actually to me
Yeah.
because I have people that trying to partner with me, and they do have 5,000 units under the belt. It might be 5,000 problems that they might have. You don't really know. So,
or they might have just the teeniest little sliver.
Yeah, absolutely.
5,000 units.
Yeah, and that's the reason why, because I'm also mentoring people, and they always they filling up the application, and it's every time the people asking them how many units you want to have in the short term. Nobody ever put less than 100, and I love those first conversation with the new students saying why do you need 100? Nobody can explain to me because the best answer they said because they told us to think big.
Right. Yeah. Yeah. That's true.
I'm saying, all right, let me just simplify it for you. If you, as a GP, general partners, will make $50 per unit, now 100 looks like a little bit different, not like abstract numbers. But I can tell you, as a GP with experience, $50 per unit is a good price. Even if you will have 25 per unit, it will be great.
Yeah.
So, but you have to add.
But you're not retiring on the beach with $25 per unit on a 100-unit portfolio. That's
unless you have 5,000 and each one of them performs.
Yeah. Exactly.
Yeah. So you have to put dollar amount to number of units. Otherwise, it's useless. It's meaningless.
Yeah. So where are you guys going with your business over the next 12 to 24 months? Where would you like to see things going?
We would love to acquire probably averaging two projects per year, 2 to 3 projects per year. That's still our goal. That's still our. It's based on achievements that we have.
Yeah.
We didn't buy anything in 2026. We bought 1 or 2 in 2025, and one of them in Texas, which is a new market for us, and we love it. And we're looking forward to meet people on every possible conference, any possible gathering, and partner with people who might be interested in partnering with us as a LP, preferably. If it's going to be a GP, so we prefer to have boots on the ground. That will be beneficial for everyone, and I don't have to fly throughout the country every 2 weeks.
Well, it sounds like you got a few of those people already. Are those some of
Yeah.
your partners right now? Yeah.
Yeah. We do have people in Texas, and we do have people in Illinois, local people. If I need to check something, and I do need to check something, they are part of GP team.
Very cool.
Yeah.
Awesome. So as we're wrapping things up in our conversation here, Roman, who are you looking to, you kind of mentioned it, but who are you looking to connect with primarily these days? Like who, you mentioned LPs and potentially co-GPs.
Yeah. First of all, it shouldn't be desperate people. They shouldn't. The people shouldn't spend the last dollars on investing in real estate. It's a business. You're giving money to the business, not to the bank.
Right.
I cannot guarantee. I can offer you the best what I can do. The people with it who can basically the minimum that they will be having good feeling about investments probably is $50,000, because if you pay, let's say, 7-8% on $25,000, you probably cannot buy even nice decent sandwich. But in New York,
In New York, yeah, I'm thinking that's a pretty nice sandwich still. It depends how many sandwiches and how often you're buying sandwiches.
On baseball game, you can spend $24 a sandwich, hot dog, but that's about it. But people who are looking for this type of asset, who look for stability, who prefer to have business that they can benefit from taxes, and that's only another part of the business. The people who might be benefiting from taxation. I'm not expert. I'm not going to give any advice on the taxes. They have to communicate and connect with their advisors. But it is possibility in this business, like otherwise you're doing business in stock market and you have to pay taxes anyway. So real estate has a definite benefit in taxation. That's the people I'm looking for. 401k people, the professional people with extra income that they want to invest in, and obviously that's the people that we're looking for, and average people as well.
Yeah, very good, Roman. So if people want to connect with you, they want to talk with you, or they want to find out more about what you guys are up to, what's the best place for them to do that?
Sure, I can. We have our marketing and branding website. It's called Veles Holdings. Veles, VELES Holdings.com. So they can find that information about us, about our property, about our story, and also contact information up there. And few of the interesting portion related to AI as well.
Very good. Roman, this has been great. Thanks very much for being on the show.
Thank you, Dave. Thank you very much for having me. Thank you.
All right, everybody, take care, and we will see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.